Hold on.
Sorry, Frances.
Oh, no problem, guys. I've had nothing but technical difficulties this week, so
All right.
something's in the air.
I hit a button that says go live,
Okay.
but we're not live. It says we're live. In the preview mode, right now it says we
Hey.
are live.
We're live. I see it now.
Oh, we are live.
Hey,
All right.
Matt.
All right, let's go.
Sorry for the technical difficulty, everybody. YouTube's fun to get used to.
Man, we need to bring like a kid on who knows how to use this stuff because
That's supposed to be me.
Well, yeah,
Oh,
we
sweet.
need someone
Okay.
younger.
All right, we got to make our segue.
Yeah, so that worked. It only took us 8 minutes. So, how many middle-aged guys does it take to start a YouTube video?
One's too
I
many.
go for 3.
Yeah.
Yeah, three.
Yeah. All right.
Maybe
well,
six if you want to reduce it to 4 minutes.
There you go.
If we brought on another middle-aged guy, we could have gotten this thing started. But
We need
now I just need to remember what I did for the next time, which I may not. But let's see. At least,
And
at
I'm
least
one
we're
to
here.
joke. I didn't help at all, so here we go.
When
Yes, thank
we
you.
go to schedule one, we'll just have to make sure auto start is enabled. That should solve it.
All right, beautiful. All right, so now we're good. So we'll get going. Welcome to episode 3 of the Rebel Finance Podcast. We have myself, Matt Tuttle, Pat Neville, Jeremy Vreeland, and special guest Frances Stacy, not to be confused with Stacy Francis.
Thank you.
You are welcome. So let's get started. First thing we want to talk about, obviously, what's on everybody's mind are the tariffs and what's going on with the market because of the tariffs. A great meme this morning I put in the newsletter of, some dude saying, me placing a trade and some guy coming up after him to tackle him saying Trump. And that's pretty much what we got going on. My sense on this is pretty simple. Trump 1.0, he used the market as a scorecard and he would be on there all the time. We have the best stock market ever. And, that's what he used as his report card. And everyone, including me, thought Trump 2.0 would be the same. And what we're realizing is he doesn't give a crap about the stock market. There's other things he's trying to do. And so, in the past, maybe he'd say something and the market would go down and then, he'd reverse it. And all right, we're all great. The Trump put. I don't think we can, have the Trump, expect we're going to have the Trump put here. The way I like to look at charts, we got a chart of SPY up here. I think the market tried to make a bottom on Tuesday and, to hit a low 572.25 for SPY and, went positive, then went back negative. That right now is an extremely important level. That's got to hold. We've got the 200-day moving average, 569.30. So if Tuesday's low doesn't hold, we're going to test that 200-day moving average. What I'm telling people in the newsletter every day is you've got to be cautious. I've got very few longs, decent amount of shorts, just ride this thing out. I don't know that there's a whole heck of a lot of upside until we get this tariff thing. So that's kind of my 2 cents. Pat, Jeremy, what are you guys thinking?
Jeremy, let me go here. Yeah.
Sure.
First thing, Matt, why, we had a discussion earlier this week about kind of adding some educational aspects to this a little bit more. So I'm going to ask you those questions first, because that's what I care about. So number one, why the 200-day? I mean, why is that kind of the arbitrary thing everyone talks about? And then, maybe some candlestick chart explanation. I mean, I've been in the business a long time, still haven't figured it out. Maybe we could talk about that a little bit.
Yeah. So a couple of things. Markets are driven a lot by psychology. And so certain levels become psychologically important. So, for example, if you look at this chart, the all-time high is 613.23. So that number is going to be what we would call resistance, where it's going to be hard for the market to kind of break through that level. The low I gave you before, 572.25, that's support. It should be hard to break through that level, but when we do break through those levels, it becomes important. Everybody looks at the 200-day moving average as a way to kind of smooth out returns. Because if you look at this daily chart of SPY, it's all over the place. But the 200-day moving average is in a nice uptrend. Once the market breaks through that, that changes the character entirely. And there are a lot of players in the market who automatically sell on a break of the 200-day moving.
Well, why 200, not 100 or 50 or 27
So
or whatever?
50, 100, 200 are all numbers people use. And it's really because that's what people use. They use the 10, they use the 20, they use the 50, they use the 200. What I watch is the 50, the 200, the 10, and the 20. Everyone's going to have their own way of looking at it. I think come up with something and stick with it. But the 200 is one where there are a lot of people who that's an automatic sell. As far as candlesticks go, I don't think there's anything in candlesticks. I like the way it kind of shows the activity. So, it'll show you.
Like, what are those big red blobs there, man? I don't really get that.
Yeah, so the top of the candlestick will show you the high of the day. The bottom will show you the low of the day. The belly shows you where it is now. And, the red is for a down day and the white is for an up day. So I just there are some people that trade off of candlesticks. I think that's voodoo. I don't think that works. But I just like the way it portrays everything so I can kind of see, okay, today's low hasn't eclipsed Tuesday's low. It hasn't eclipsed yesterday's low. And, right now we're inside of yesterday, which is also important. So I just visually like how it portrays everything.
All right, last thing, because I wanted to bring this up. Well, I'm sorry. One last thing.
Oh, I just wanted to say, hey, Matt,
please.
can I just jump in on the candlestick conversation
really
quickly?
Please, yeah.
Yeah, so I personally love candlesticks because it's kind of what I grew up with. So that's a thing. But my favorite analogy for candlesticks is if you can just imagine the game tug of war. So you constantly have buyers and sellers coming into the market unless you have straight up or straight down. And so you can tell where the momentum is lying each day, or you can look at a 1 minute candle, a 5 minute candle, a 15-minute candle. 1 minute candles will make you go crazy, but you can tell where that momentum, who's winning out of that momentum. And then Matt made an extremely important point. Sometimes those levels of support and resistance that are so important, and it takes extra momentum to get beyond those levels of support and resistance. So if something goes through resistance, those buyers are winning that tug of war much more. Or that if it falls through support, those sellers are winning that tug of war. It's a bigger move, and that's why they call it breaking out to the upside. So the nice thing about candlesticks is sometimes it's that intraday low, which is the wick, right? Or it's that intraday high, and it's not between the open and the close. The belly of it's between the open and the close. And sometimes it's those wicks, and these bottoms and tops are tested intraday. And so the candlestick gives you the ability to see what occurred intraday, even if you don't watch the markets all day, every day. So I think that they're, maybe I just grew up on them and I'm so comfortable with them, but I do think that there's some kind of like the 200 200-day moving average. I just think that it's people who watch candlesticks. That's what we're watching.
Yeah. Jeremy, I don't think I've seen your charts. Do you use candlesticks?
Religiously, and I guess
okay, all right.
Realistically, voodoo is what I do because I'm down on that 1 minute level. But another thing that just to add real quick is whenever you want to find zones where there's going to be I call them liquidity zones. It's important to pay attention to where those wicks are, both on the daily. I like to use the 2 hour. During extreme volatility like we've had lately, I'll go down to the 15-minute charts and look at bigger candles with longer wicks and map those out because those wicks are typically created by a swing through and back through limit orders. So when you see where the limit orders are, obviously there's a bunch of liquidity there. It's almost like supply and demand zones. So if you map those out and pay attention to those, it's like an easy way to find support and resistance on any time frame, regardless of what the moving averages are telling you. So yeah, I practice that on a 5-second chart, so it gets nuts. But
so true, and you make such you make such an excellent point, because a lot of people think that stop losses are guaranteed,
right?
And they're not. First of all, there's order execution. So if you pick a stop loss that a lot of other people have, it'll only execute those orders while it's sitting at that price. So if it doesn't sit at that price long enough to move through those orders, which this wick volatility is designed to change order flow. And so market makers particularly can see that. And it's exactly what you said. It's whipsawing through those limit orders. And that's why when people are, crashing out of the market or crashing into the market, they use market orders, which of course you lose some control, with calculating your potential gains and losses there. But that is indicative by the wick. That's such a great point, Jeremy.
Frances, we're inviting you back. We're inviting you back.
Pat,
Thank you very much.
One other point too, on these key support and resistance areas, I think a couple weeks ago I was talking about how I've been doing some more cash secured puts because I don't think the market's going anywhere, and that's a way for me to take advantage of time decay. When I am looking at a level to sell a put, I'm looking at these levels. So, I'm not selling puts right now on SPY, but if I were selling puts on SPY, what I'd probably do is put them somewhere below the 200-day moving average, assuming that is going to act as some sort of support and, unlikely to see the market go through it. Now, I do think the market could very well go through it, which is why I'm not selling S&P puts below it. But if I were, I'd be looking at levels like that.
Okay, well,
if I were selling a call, I'd put it above, 613, figuring it's not going there.
All right, well, I had a little bit of an agenda, and I may be taking too much time. My last thing, though, you talk about mean reversion a lot, Matt, or you say the undercut rally, 200-day. Can you explain what you mean by the 200-day undercut rally? You talk about that a lot.
Let me see if I can find.
We both do.
You both do, right?
Here's a good chart. So I am a counter trend guy. There are two ways if you're looking at charts that you could try to trade. You could try to trade breakouts, or you can trade counter trend moves. I don't trade breakouts. I don't think trading breakouts works anymore. And I think the people who are either that's a previous low that's important or a moving average. So here's Salesforce. Salesforce on Tuesday broke below the 200-day moving average, and then yesterday broke back above. That is an undercut and rally. And so I bought Salesforce, I think yesterday. And so, the way you play that type of move is you buy it when it rallies back above the 200-day moving average. Because what happens is, like I said, people sell. So you shake out the weak hands, and then people are buying the dip. It goes back up, no guarantee. And then on something like this, I'd put a stop, somewhere, around 282, give or take. And it either works and I ride it up, or it doesn't and I get stopped out. But I get stopped out at, a fairly close level to where this is. So just that's my favorite chart pattern to trade.
Got it. All right, cool.
That's awesome. Pat, can I just say something really quickly?
Please, I'm done.
No, but sometimes when you have these undercut rallies, which I like that description a lot, market makers are going down and stealing those stops. They can see those stops just sitting there under that 200-day moving average. And as Matt previously alluded to, that is a very popular place for people to hit the sell button. So that can be a very crowded trade. And so sometimes you can get very creative with the prices that you use for your limit orders. If you can make them as odd as humanly possible, you increase your odds of not being so far down that line. that they just jump down, fill those stop orders, and then just jump the market right back up again. And
so you mean like price it at $293.05 versus $293 or whatever is what you're saying, right?
Something. I mean, it's been a while since I've traded these because I'm more into the wealth management these days. But I used to, like, especially floor traders like those really round numbers. But yeah, instead of doing an order at 220, I would do it at like 217 or 213 or just something. It's hard to say because you can't really see where you are in those lines, but it's a couple of cents, and you could increase your priority on the order fill.
Right.
Now everybody's going to do that, and I started a new trend, and now there's no alpha in that anymore.
Let's get back to tariffs. Jeremy, your thoughts, and then we'll go to Frances.
Sure. Quick on price action, reversion is a key word there, because if you look at that chart that you have up there with CRM, look at the previous trend from like November on into the high, and we're exactly at half that trend. We've given half back. Here's where buyers will be. Half back returning the previous trend in the shorter term is 328. We targeted that last week when we talked about it, and it's beautiful. We nailed it. So now we get into things that are acting on the market. Tariffs. Oh man, that's the greatest thing ever. Now we've got like range in futures trading that is phenomenal. I mean, we're scalping 100-point swings in the NQ daily, and it's just been like whack-a-mole. It's awesome. Compare
what
that.
Is the NQ?
NASDAQ.
NQ is NASDAQ futures. And essentially, it's just been so easy to scalp that. That's what we do while we're biding our time to take long-term entries into bigger, better things, or even setting up for what I like to do with the wheel trade, just selling options on either side. And this is a great time to kind of settle in, start selling some puts on that half-back support level on many different equities and roll with it. Going into the meantime, if you feel like watching the market all day, go scalp the futures. It's great. So it passes the time and makes you money while you wait.
Should we have a disclaimer like stuntman lighting houses on fire or cars on fire? Like maybe don't try that at home, or maybe paper trade that at home for a little while.
Start with paper. Definitely get used to the function first. Yeah, don't dive into it.
What did you say, stuntman? What was that? That was a new one. I haven't heard that one. Stuntman.
No, like you see these things on TV where they blow up houses and cars, and the
don't try
stuntman
this
is
at
great,
home,
and they're like, "Don't try this at home."
Yeah, exactly.
Right? Professionals make things look easy, right?
Right. Yeah. No, it's funny though.
This is our rendition of Mythbusters. We got to have that disclaimer.
Yeah, exactly. I definitely have some trading scars, so they happen for everybody. When they start out.
They definitely do, except for people on FinTwit.
Exactly.
Never lost any money on a trade.
Oh man, yeah, they're all winners.
Yep.
Yeah,
all right, Frances, your thoughts on the tariffs here?
Well, so the tariffs are in the short term a generator of volatility, which traders like. Wealth managers not so much. And I think
Jeremy's loving it.
Jeremy's loving it.
Oh,
Jeremy's well outside of the paper training wheels, and so Jeremy's loving it. People who still have their training wheels don't always love it as much. I've been there. I've been on both sides of that trade, literally. And so when you merge some of these things, so when you look at things like the 200-day moving average and you want to assign some kind of probability to whether or not you think it's going to break down, you can. It's very informative. And of course, this is the most famous person in the world to do this is Ray Dalio, who of course found Bridgewater and Associates. But you look at the global macro, where is the economic cycle? And there are 4 seasons to the economic cycle. Season number 1, you have growth going up and inflation going down, and lots of assets perform in a particular way in that. Season number 2, you have growth and inflation going up, or the rate of change, they're accelerating simultaneously. Season 3 is kind of stagflation, growth is going down, inflation is going up. And season 4, both growth and inflation are moving down. Depending on how bad that is, that could be a major recession, a major pullback, and you can actually hit a deflationary. It's either disinflationary from previous highs of inflation, or it can go deflationary, which means the prices actually drop. So when you look at that season, those are seasons of an economic cycle. And so you hear a lot of professionals talk about being late cycle. Late cycle has to do with the debt load in countries, has to do with the leverage amounts. And a lot of debt creates inflation. And then what happens is the Fed comes in and tightens monetary policy by raising interest rates and also reducing the liquidity in their balance sheet. And what happens is that draws the liquidity out of the economy. Well, what is the S&P 500? It's a liquidity meter. And the balance sheet for the Fed is heavily correlated with the S&P 500. So if we're looking at this both from the trading perspective, but also from the wealth management perspective, obviously not day trading my clients' retirement accounts. So I know Jeremy's so disappointed, particularly, right?
If I ran a fund.
Yeah, we're not hitting the NQ with people's IRAs. No, but what's interesting about this is I have to be able to look at this and assess what the overall probability or where the risk lies in it moving through or below the 200-day moving average. And a lot of that is liquidity in the system. Now, there are two sources of massive liquidity in the system. And one is monetary policy, obviously, when the Fed is purchasing bonds and securities. And then the other is the fiscal spending. The fiscal spending was really, really high during the Biden administration. And so even though the Fed was reducing the liquidity, the fiscal spending was buffering that reduction of liquidity, which made the fact that we raised interest rates so much, it did not trigger a credit event. There are a few reasons for that, but a lot of it was the fiscal spending. So you have Trump coming in. One of the guarantees they've had is reducing the fiscal spending because the deficit and debt of the US is in a precarious place on the global stage. So Trump is using tariffs as a tool. So there are some short-term goals and some long-term goals, but Trump is very much the art of the deal, love him or hate him. And the short-term goals is he's trying to keep America prominently on the global stage. And we are not in the prominent position we were when we originally got the US dollar as the world's reserve currency with Bretton Woods many, many years ago. So he's trying to make America great. He's trying to return us back to that status. And so the short-term goals are to use the tariffs as leverage. Most countries around the world, certainly those trade partners, benefit off of American consumerism because we are big consumers, the biggest. And so what he's doing is he's threatening to raise tariffs. And because American consumers are a big part of Canada's GDP, Mexico's GDP, China's GDP, he knows that if we stop consuming from those countries, we're going to damage their GDP. And that's the leverage that he's using to have them capitulate and do various things that he wants them to do. He cites fentanyl trade, he cites border security issues and various things. And so that's the short-term goal of tariffs. And he's basically wanting these countries to feel the pain in their growth and eventually, either if not initially, eventually capitulate. But when you do that to a system, you're making such huge adjustments to those, supply chain mechanisms and the trades, which we're finding. That will create some market volatility, and that is what we're seeing. The long-term goals, really, he wants to keep the US dollar as the world's reserve currency because that's what keeps demand in our debt markets, and demand in our debt markets is what keeps us solvent through the various economic cycles. And the US has obviously enjoyed that.
Demand in our debt markets.
Yes, exactly. So basically, he told the BRICS Alliance was there were whispers. They had their 16th annual conference, and there were whispers that they were trying to create a currency that replaces the US dollar. The argument that they have is the level of debt and deficit that America is currently experiencing. So Trump is trying to play multi-dimensional chess here. And he basically said, you guys want to try to undermine the US dollar, you can say goodbye to the American consumer. I will raise your tariffs to 100%. And he knows, because he's done his homework, that will meaningfully affect the GDP of those countries. So it remains to be seen how this turns out. You've got the pro-Trump people saying, okay, we will accept the volatility in the interim because the longer term goals are so viable for the American people. And to have them, some people even feel that having America be stable is beneficial for the rest of the world. That's a different podcast, different debate. So they're willing to put up with the short-term volatility. And then obviously some people are very uncomfortable. But when you see what he's doing, then you take that over to where we are in the economic cycle, how much of the fiscal spending is being actually pulled out of the system, where we're going with unemployment, where we think the Fed is going to go with that. And then we look at our candlesticks and 200-day moving average.
So, all right. So great stuff. Implications for investors. So I know for, Jeremy, it is a day trader's paradise, but you can't get up and go to the bathroom.
Nope.
You get up and go to the bathroom, your winning trade turned into a massive losing trade because you have no idea what's going to happen. But if you can sit in front of a screen from 9:30 to 4 and you know how to read a chart, you're loving this. For swing traders, which I guess is what I would classify myself, this is fine. I mean, I'm not going to flip my portfolio net short. I always have some shorts. I mean, heat formula, H for hedges. I've always got some shorts. I'm not going to flip net short. So I'm not trying to make money in an environment like this. I'm just trying not to lose. So, I'm cutting things maybe a little bit quicker than I normally would if something starts to sell off. Shoot first, ask questions later. I am picking up long positions, but my position size is lower. Like I said before, I'm also doing some put selling, and I'm also structuring my trades like ratio spreads and things like that, where if something has a big move, I make money, but if it goes down, I break even. So, Frances, you're dealing, with buy and hold guys. So what's your sense of implications for them?
Well, it's really interesting. I mean, the thing that I think is the safest, so completely buying and holding, you unfortunately, when you hit a major economic cycle, which, by the way, the bull market is a bull market about 85% of the time. The severe bear markets are only about 15% of the time, and that's why buying and holding works. But when you look at the statistics of the wealth gap, it's the 1%ers, Jeremy.
I'm not that rich yet.
No, I'm kidding.
Yeah.
It's these guys that have the skill set. It's the Ray Dalios. It's the people who have access to those types of investments that they don't lose in any season of the market, generally speaking. And I think Ray Dalio is famous for not losing money for 20 years straight or something like that. Because what they're doing is they're adjusting their exposure based on these inflation and deflation ratios. They probably have some alpha from some day trading because they have the resources to do that. And they're, constantly kind of buffering what's going on from a global macro perspective. In two of those seasons, the first two seasons where you have growth going up and inflation going down, and you have both growth and inflation accelerating or going up at the same time, the bottom up stock picking type stuff works a little bit better. You can find the markets are very efficient, meaning that most everybody knows most information. So for you to get an edge on your information, there's just not a lot going on out there, particularly with AI. That gap is going to close even more. But that's where you kind of get really into the weeds on stock picking, and you can kind of manage a portfolio on that basis. When you get into seasons 3 and 4, so stagflation or potentially deflation, either disinflation or deflation, with attendant falling growth, the global macro will take over. You can have the best tech stocks in the world, and if this market crashes and we have a credit event and we have a massive sell-off and a massive recession, those companies, even if they're the best in the world and even if they have a ton of cash on the balance sheet, are going to sell off in tandem with the liquidity and what's occurring in the global macro cycle. So what I worked at a previous firm where we tried to optimize the sector strength in those given cycles. And what we would do is we would take a lot of back tested data, like for instance, and we would do kind of an endowment style portfolio where gold doesn't perform the same in every season. Cash doesn't perform the same in every season. There is no asset class that performs well in every single season.
So where are we now? Let me
I'd
just
say season. I vote for season 3.
What season is that again? That's the inflation.
No, that's
Stagflation?
stagflation.
Stagflation.
Yeah, right.
Inflation reaccelerating, growth going down.
I think so
wait,
too. So at
Francis,
least we're on the same page.
Well,
Yeah.
So Francis, what are we? Again, I vote 3, but you tell us.
I'm with you on 3 right now. The thing that has become unique about the cycle, I would say, in the last 5 years, the trading and the volatility and the 0 days to expiration and some of these metrics have changed. What's happening is these seasons are changing more rapidly, and they're going back and forth between the seasons. It used to be like a couple of quarters in a season, and now it's like, you're going between those seasons constantly. So season 3.
Frances, let me ask you a question. Okay?
Yes.
I'm going to cut you off here. All right.
Oh, good.
I just read this article and it's out there. California's $20 per hour minimum wage for fast food workers has backfired, raising prices by 14.5%, almost double the national average and leading to a loss of 10,700 jobs, right? So that's stagflation, right? Prices up 14.5%, 10,000 lost jobs.
Yeah.
Is that kind of what you're saying?
Yeah, totally. So what happens is these seasons are fluid, right? And they have various causes and effects. So what happens is exactly what you say. You go through an era of stagflation, which I agree with Matt, that's where we're at, where prices are moving higher and growth is going lower. And the Atlanta GDP just came out and projected negative growth. So there you are, right? That's quintessentially the definition. However, what happens is exactly what you're saying, Pat. The prices get too high, so that lowers the demand, right? Which puts further pressure on growth. And then companies then have to adjust by reducing costs, and then they lay off people, and then that triggers the labor market. And these things kind of have this concatenation of events, a domino effect, if you will. And then that's how stagflation can roll into a deflationary cycle. If you have simultaneous to that, you have a lot of reduction in fiscal spending. You have a lot of unemployment with federal workers who don't immediately find private sector jobs, and private sector is not going to be hiring if growth is declining. We're hearing about layoffs, those kinds of things. And so unemployment goes up, the Fed starts easing, you start to get a lot of stimulus. Jay Powell is speaking tomorrow, but his big mantra is that he's not trying to front run fiscal policy, but he sort of has to, even if he says he's not going to. And so we're just going to have to see what kind of disruption occurs in the switching of the operating basis that Trump has kind of promised and feels that it's his mandate, and Elon Musk. And basically, when they took office, about 40% of America's GDP was coming from government spending, so federal, state, local, etc. And about 43%, according to the NFIB, was coming from the private sector, right? So the public and private sector were both making these contributions to GDP. What Elon wants to do, which you guys got to go listen to him in November on the All In podcast, because he really gets into this. He thinks of it like a tech operating basis or an operating system. And what they want to do is reduce the GDP from government spending and increase the GDP for the private sector. And that's going to reduce the debt and deficit. And that's going to keep us prominently on that global stage. That's going to keep the US dollar in place. And so that's the long-term chess move. And they're going to probably cause some disruption in the short term, and particularly in the liquidity.
All right. So couple of things. So Pat, remember we had stagflation in the early 70s. I mean, Francis and I were very young. You were probably in your 30s back then. So you should remember that a lot better.
No, dude, I had the worst 3 Dog Night haircut. Like I had bangs like down to here in the 70s, and I was like,
I could imagine.
That's
For the
awesome.
record, Frances wasn't born yet. Frances was in her past life.
Oh, okay. All right. I was a kid. I know Jeremy wasn't born, and yeah, I mean Pat was already middle-aged back then. So
no, but,
you were dealing with it.
The stagflation thing I agree with, by the way. I think you've hit it spot on, Francis, by the way. Anyway, go ahead, man.
Yeah, so then the question is, if we are in season 3, again, kind of implications for buy and hold investors. I know Jeremy doesn't care. I don't care.
I do, but in a different way.
Well, right, but
I'll explain.
If we enter a bear market, it's not going to affect your pocketbook. It's not going to affect my trading, obviously it affects my ETF business. We've got inverse ETFs, but the inverse ETFs are a fraction of the size of the long. So obviously, I want to see the market go up, but from my trading, I mean, I'm not going to lose money. I don't really care. And, in bear market rallies are some of the best trading opportunities. But, again, Frances, you're a buy and hold investor. What should you be thinking about here? And I'm not saying you're a buy and hold investor. I have no idea. I'm saying the buy and hold investors you're talking to.
Right. Obviously, retail, retirement, people like that are not going to be comfortable with day trading their retirement. No,
they could hand it over to Jeremy.
Yeah. So my old firm, what we did was we really tried to optimize various. Yeah, we can hand it over to Jeremy. We could do that. Let me make sure I've got enough cash.
All right, we're going to set up a GoFundMe for Jeremy's trade.
Yeah.
There you go.
And Frances's legal funds, please. Keep Frances out of jail. Thank you.
With that kind of size, though, I would just have to add that I'm very well versed in options trading, and I know exactly the strategy to run exactly that without day trading. And it's something that you mentioned earlier when you said adjusted exposure, and that is like the collar strategy in a nutshell, and you get paid for it. So that's something I kind of imagine most fund managers running with is having a collar in place to protect some downside, limit exposure, and then take advantage of the volatility at the same time.
Yes. And my new firm does things a little differently. Basically, they have a bucket approach, and they look at the liquidity needs, because the worst thing you can do as a retail investor is need liquidity when you're experiencing a sell-off or a drawdown. And so what they do is they put the more cyclical stuff in the longer term liquidity strategy, and they put obviously the more fixed income, less risk, less volatility, which I don't know, the bond market's had a heck of a lot of volatility in the last several years. But they think with that, in that what they don't want you to have to do is get liquidity on the low. So two different ways of looking at that. It depends on someone's net worth, but the drawdowns are what are causing the wealth gap.
Right.
So when you go back to that global macro economic thing, and Ray Dalio has done the finest research I've seen on this. He has a big research budget. So the Jeremys of the world win whether the market's going up or down. Matt and Jeremy, you guys win when the market's going up and down. So you guys don't experience those massive drawdowns. The people stuck in retirement accounts, 401ks, they're invested, so they're doing better than people who have no assets, even in that buy and hold scenario. But unfortunately, when you experience a drawdown of, say, 50%, which did happen during the global financial crisis, I think the S&P went down 52.
Yep.
60% in some cases, depending on various things. 50%, you have to have 100% to get back to even. So while you're getting 100% performance and all those years are going by while you're just going to get back to even, Jeremy is already off to the races again. And that's really what's creating the wealth gap. And then the bottom, so this is why we call it the K-shaped economy. If you picture the letter K, the bottom, they don't even own assets. So they lose in deflation because they lose jobs and they lose income. And then they lose in inflation because the cost of living goes up so much that they can't keep up and they can't buy the things that they used to buy. And this is what creates the wealth gap. And then when you get to you have a huge economic cycle, again, Ray Dalio, when you get to the end of a multitude of those economic cycles with all the various seasons, you have a situation where the wealth gap becomes too exacerbated, the country becomes too indebted, and you have some massive disruption. And he's saying we're on the precipice of that, and Trump is trying to prevent it.
Yeah, I just read that 10% of earners have 49.7% of spending.
Yeah, very, very unequal. And
yeah.
I've seen some crazy statistics. CNBC had a statistic of over 60% of people are living paycheck to paycheck, even if their paychecks are $100,000 a year. Recently, somebody else gave me a statistic that I haven't verified, but that has moved significantly higher, well into the 70%. So if you can imagine, if people are living paycheck to paycheck and unemployment goes up, whether federal or in the private sector from layoffs, anticipating lower growth, right, which companies try to do, you can see that could trigger a credit event. The credit event, so you can have recessions without a credit event. If you have a credit event, what do I mean by a credit event? I just mean some massive default that is systemic. Obviously, the global financial crisis, it was the housing market, right? If you have a credit event, you are going to get massive market disruption because credit events cause severe drops in liquidity. And that's what causes markets to sell off mechanically.
All right. So, couple of theoretically, that should act as support. And if the market's going to bounce, it'll bounce there. We'll see whether that plays out. Another thing, so we've talked about how, I don't think Trump 2.0 cares about the stock market. What I do think he cares about is he cares about interest rates, because one of the things they want to do is they want to make home ownership affordable for that other part of the country. Oh, and before I forget, on that discussion, important point that I've talked about a fair amount is, how, the economy is the haves and the have-nots. And I think that's why we had so much confusion over Bidenomics, where you'd have people on the news saying, you guys are crazy, this is a great economy, because, they're sitting there, they're the haves. And for them, who cares? I don't care about inflation. I'd rather not have it, but it's not going to change my life. If gas is up, that's whatever. But you've got so much of the country that's hurting. And, one of the reasons, not to get political, but one of the reasons the Democrats lost is they're not talking to those people. And Trump is. And those people, a lot of them don't own assets, but interest rates impact them. I've been talking about, so here's the 10-year. It's actually gone up the past 3 days, which is interesting. I've been in TLT, which is the ETF for long-term treasuries. It's been a great trade. It's turning now. I still like it, and we're off the lows. I still think this is the Trump trade, betting on lower interest rates, not betting on higher markets. What I would suggest to buy and hold people is, again, going back to the H.E.A.T formula, the H for hedges. Always have hedges in place. Like, one of my favorite is ARK. ARK Innovation ETF is the dumpster fire of ETFs. Now, theoretically, you could always have a short position on this. And you could buy puts and have that in a long-term account. I don't like doing that because every once in a while it has a run. What I do like doing now, Patrick, going back to our support levels, is I bought puts on ARK when it broke the 10-day moving average. I bought more when it broke the 50. And, then when it had an undercut and rally at the 20-day, I got rid of a lot of my puts. That's not that hard to do. You don't have to be a rocket scientist. And even if you get it wrong, having puts on ARK, probably not such a bad trade. That's one thing you can do. And I'll give you previews of coming attractions. We're working on, and hopefully filing next week, maybe this week, an ETF where we're always long the VIX. The VIX is the fear index. So when people are afraid, VIX spikes. So you've seen in this latest move, VIX has gone from 15 to 24. And big move in not a big period of time. So we're going to have an ETF coming out that gives exposure to VIX, but mitigates when stuff like this happens. Because when VIX is unlike the market doesn't need a reason to stay elevated. VIX does. So at some point, VIX is going to come crashing down. So don't try this at home. But that would be my quick. And I've got more, but that would be my quick advice to the buy and hold guys of some stuff you could add to your portfolio to make your life a little less taxing at times like these.
Which is going long VIX, is what you're saying?
Going long VIX. Again, individual investor, I would not do that. 99% of the time, VIX is going to go down. Leave VIX to the professionals, but I mean, you don't go wrong often buying puts on ARK.
I hope I never end up in the dumpster fire of economic strategists on your podcast.
I mean, I've shorted Kramer. I've shorted.
That was good.
I could do the short Frances Stacy. We'll see how you do.
Dear.
Oh,
No. You can short Stacy Frances, not Frances.
There you go.
Frances.
All right, can I digress for a minute, please? Sure. So I did something funny this week, right? We talk about like McDonald's prices and all that, and I actually pulled into McDonald's. I've read that cheeseburgers went from $1 to $3.15 in the last like 5 years. So that's like 250% bounce. But I went in during the morning, right? And I didn't realize they didn't serve burgers in the morning. And they had McMuffins up there, right? I want to ask you guys a question. So a McMuffin meal, which is a McMuffin, coffee, and like a hash brown. How much you think that costs? Matt?
$6.
I haven't been to McDonald's in probably 5 years.
I haven't been to McDonald's in like 40, but I'd say
25 years. Yeah, go ahead.
All right, go ahead, Jeremy.
I would assume right around $5-6.
Okay. Frances Stacy.
I'm gonna say $9.50.
That's not bad. $9.99.
Wow.
That's a lot, right?
That was my second guess.
That's a lot, right? So I'm going to like start my own thing. I'm going to call it not the Big Mac Index. I'm going to call it the Egg McMuffin Index, and it starts today at $9.99. I'm going to look at it from time to time. Well, we have these guns, ETF T-shirts that Matt will sign and send you. They're sleeveless. They say
"Guns out, guns out."
They say "Suns out, guns out" on the back. You know,
nice.
You won't win any. All right. So just in the theme, right? This is a Maha theme question. So how many calories are in that meal? Let's just see how that changes over time. Matt?
I will take another angle on that and say it doesn't matter. What matters is how many chemicals that cause cancer and metabolic dysfunction are in that meal. And I'd say 50. Calories, I mean, we can have this argument another time. Calories in, calories out is not.
So you're not going to give me a number?
I'm going to say 1350 on the calories.
Oh, well, only 640. So I guess that's pretty good.
See, there you go.
I don't know.
I lost my guns T-shirt. I'm now only one for
Matt
two.
will sign it. Matt's going to sign. I'm going to make him sign you one.
I will definitely sign her one. I hope your arms look good because it's a muscle T-shirt.
Fantastic.
All right, one more thing.
I'll start working on this stuff.
I want to get your guys' opinion on HOOD. Okay, which is Robinhood. And then we have a 2X fund, ROBN, which is 2X on the upside. And in this kind of market, wouldn't like a 2X fund make more sense if you were going to buy into Robinhood, crypto czar, crypto this, crypto that, all this crypto stuff? Wouldn't this be the play? Like a 2X, Robin long and, scalp it here?
Can I make one comment and then I'll let the super professional
No, I want to get the smart opinion from you first, and then we'll let those guys talk.
Yeah.
No. These guys are super smart. I'm excited. I've learned things today. So if you just look at the basic pattern of this chart, like the first thing I would notice about the basic pattern of this chart is that it loosely is correlated to the S&P 500. So a lot of stocks have a similar shape.
Totally
to the
agree.
S&P 500. And so if they have a similar shape, regardless of the individual names in seasons 3 and 4, there's going to be a lot of correlation. So it's not necessarily as much about the individual companies. It's about that level of correlation.
Can I wear white in season 3 and 4, by the way? I'm just curious.
You can't wear linen. I think it's fine. You can wear white.
Oh, okay. All right. That's good.
There you go.
So, all right. So here's my thought on the chart. And then Jeremy, you can chime in. Look at it around the 50-day. So it sold off hard with everything. And now it's struggling around the 50-day to try to figure out which way it wants to go. The only thing, crypto's selling off too. This morning when I woke up, everything looked awful except for crypto. Now crypto turned bad. there is a crypto play here, which, makes it maybe more attractive than some other things, assuming crypto stays afloat. But, it's just, it's a perfect 2xable stock. Does it make sense here? It depends on what strategy you're running. But this is a stock that retail investors like to trade, and they like to trade it because it moves. And one of the things I like about candlesticks is it tells you, the range. And guys like Jeremy, you love range. You don't want something that has these little, tight candlesticks that doesn't move a lot. This stock moves.
Yeah, it does.
So, would I buy it here and hold on to it long? I want to see what it does on the 50-day. Would I trade it if I were day trading still, which I don't have time to do? I would love to day trade it. So, Jeremy, your thoughts on Hood?
Yeah, I would have shorted it this morning, but looking at the long term on this thing, I can see that support is pretty much, again, a halfback scenario. If you look all the way back to November there where that low is, and run that whole trend, we're not quite back to half just yet. So I would say we're probably a little bearish down to between like $42 and $40 or so. And then maybe I would take some interest in longs, unless somehow it broke back above that 50-day, which is not looking so good at the moment. But this is one of those charts where you got to wait for it. It's going to be a let's patiently wait for our opportunity. And when it starts looking easy, that's when we trade it.
So
one last unplanned question. Hold
on. Just so you guys know, I did end up, I bought puts on Hood yesterday when it failed at the 50-day. So just, full disclosure.
And you're in the money on those now?
What's that?
You're in the money on those now?
I better be.
He usually opens his in the money. I'm out of the money guy.
I'm not watching. I'm not in the money. Are you making money? Is probably the better question.
Wait, Matt, sorry, Matt, I didn't hear you. Are you in the money?
Yeah. I'm up.
Oh, you are.
All right, last question. Okay. All right, then I'm done. So, do you think ROBN, which is our 2x, is the chart when you look at these? Would you look at the ROBN chart, or would you? Look at the Hood chart? Underlying. Okay. All right. Cool. All right. That's it. Thank you.
So my take on that. Currently, the better alpha for a 2x leverage chart at the moment, hands down, MSTU. That is insane. And reason why is the premium's incredible. It's trading it, just the other day when Matt and I bought into it, MSTU was trading at like 460, 475. That's a bargain. And then you got crypto spiked up this morning. I was able to sell some covered calls in this morning. I'm pretty much set on that one. My cost basis is so stinking low, it's going to pay me over and over and over again. But running a wheel trade on something like that, it can be risky. It's leverage. It's an ETF that's based on something that's already volatile, and then throw crypto in it too. We all know how crypto works.
Do we have time here to ask Jeremy what a wheel trade is? Because he talks about that quite a bit.
That's my mantra.
Can you do that in a minute or two, man?
I can get into it. It's pretty simple. So you look for.
It isn't that simple, but go ahead.
Yeah, don't try this at home. It's pretty
sure. Yeah. Study first. I've written an article about explaining how to do it. If you go to the Bullish Bears website and search on our blog for the wheel trade strategy, you'll find some gold there. Trust me. Going into something like this, it's as simple as charting, finding those support and resistance levels, and literally just selling options contracts within those ranges. And if it's down, sell puts. If it's up, sell calls. Rinse and repeat. Eventually, you make enough premium to make the cost basis on your net long position free, and then eventually negative. It just pays you as time goes on. So you're getting paid to wait. It's the greatest thing ever. Something like this where it's leveraged, you tend to have very high volatility pushing up the premium values on those put and call strikes. I mean, getting 50 cents for a 450 strike that expires in 2 weeks is incredible when the stock is trading at $4.
So what you're saying is stock gets crushed. The put premiums go through the roof. You sell the put when the stock gets crushed. Is what you're saying. And is it in the money, out of the money? Where? How long out? 1 day, 2 days, a month, a year? What do you do?
Usually I like to do a strike or two out of the money, and then anywhere from like 1 to 3 weeks expiration if it's got weeklies and it's got the volatility or volume to have those weeklies be worthwhile. Yeah, those are where I'm focusing.
So how far out again? I'm sorry, man. I lost.
Typically anywhere between 1 and 3 weeks, just depending on how overpriced those options tend to be.
And a little bit out of the money.
A little bit out of the money.
All right, cool. Thanks.
Really quickly, guys, I know we're coming to a close. I just want to make 2 points, other than the previous point of don't try this stuff at home. Trade paper first.
Yep. Learn it.
Keep Frances out of jail.
Oh, no, OPM, right?
And Matt
OPM.
and Jeremy.
Yeah, please.
And Pat. None of us would do well in that culture. So, no, I just want to say 2 things. Number one, I have a huge amount of compassion for the people out there that have job disruption or other disruptions going on with some of the fiscal changes, the tariffs. I have friends in Canada who are calling me. They're like, oh my God, the US, isn't calling us anymore. And they are freaking out. I have a ton of compassion for that. Secondly, what I think is going to be the big disruptor, and I want to participate in it, and I know you guys want to participate, is portfolio management through these economic seasons has become a race to the bottom with fees. Some of the index funds they continuously just lower their fees, and that's how they're trying to create the quote unquote alpha. And I really think if you take something as genius as the H.E.A.T formula and you can apply that with the global macroeconomics to portfolio management, I think you have something that's really unique, potentially disruptive, is not a victim to huge volatility created by 0 days to expiration or other sort of gamma plays that are happening that Jeremy likes, but most people can't stomach. I think there's a great opportunity. I would love to come back and talk about how to kind of like merge those 2 worlds.
All right, you're in.
I'm an advocate for that. I've been doing that's the whole reason I reached out to Matthew is to go and kind of bridge the gap between retail and professional, and at the same time we got to poke a little fun at Jim Cramer, which is always a bonus. But it's developed into exactly this. This is the bridge. This is what we're trying to build, and it's great to have this level of professionalism from retail to absolute professional in the same place. And literally
let's serve all sections of that wealth gap. I really think that there are a lot of people out there who could benefit from our collective knowledge and collective trading scars. So
agreed.
All right, cool. I mean, I think we'll end it there. Frances, thanks for coming on.
Frances.
I mean, I'd love to.
Pleasure.
I'd love to have you on as much as you're willing to be on.
Okay, we will discuss. I love it.
Yeah, I mean the less that Pat talks, the better. So we need
no.
Got to drown him out.
Yeah,
I deal with it. Just so you know, I get this all day, every day. You know what I mean? But I like it because it makes me feel wanted and I get the attention. But I get this all day, every day.
I mean, it's better than us ignoring you.
That's what this chemistry is.
Listen,
Exactly.
I'm a recovering drama addict. It's totally fine. we can get into that someday.
All right, see you guys. Thank you. Have a good day.
All right,
Thank you.
Thanks,
You too.
everyone.
We'll see you next week. Thanks again, guys.